And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the end of the month for The Real Investment Show. Of course, this has been a very long month. Started out okay. Had a holiday, July the 4th, and we had hurricanes and storms and Biden dropping out of the election. I just need this month over with. This week, of course, is the Federal Reserve meeting. Starts on Tuesday, concludes on Wednesday. Will we, won't we get a rate cut? That's going to be the big question. I suspect not. It's possible. Right now, Fed Fund futures are predicting 3 rate cuts for this year. So we went from 6 at the beginning of the year to none, now back to 3. So we've been all over the board. Wall Street very optimistic. Of course, the Fed's going to cut rates. And the data certainly is now starting to support that. Consumers obviously under a lot of pressure. McDonald's just reported earnings this morning. Reported misses on both revenue and earnings for the company as consumers are drawing back. Their same-store sales down 1% quarter over quarter. So again, we are seeing the impact of these higher rates on consumers, lack of wage growth, inflation, all that. We've been talking about that for a while. Now starting to actually show up in these earnings announcements. And McDonald's is fast food franchise for the poor, so to speak, right? It's not so cheap anymore. It used to be, that's where you went, got your $5 meal, whatever it was. You used to have the dollar value. Remember the dollar value menu? Remember those days?
Oh, yeah.
Yeah, you go there for the dollar deals, but not anymore. That's the whole problem with what's been happening over the last few years. But those earnings missing pretty sharply across the board this morning. Stocks will be down a little bit this morning. It's already been under a lot of pressure for a while. But the real story here is that the consumer is under pressure, now starting to be reflected in items like McDonald's, Heineken, beer. It's bad when people stop buying beer. Heineken also missed their sales as well, so that stock's going to be down about 7% this morning. But we've known this is coming, right? And this is kind of where it's now starting to show up in the consumer. And of course, a lot of this has been because all that money that they were given is now running out, and now the implications are, the obvious, right? Which is they've got less money to spend. Interestingly enough, I'm writing an article on this, but we tried MMT, right? Modern monetary theory. This was the whole idea of just, hey, you know what? The government's debt is the public's asset. Right? So the government issues debt and we give money to people and it's all great, right? It's checks and balances. That's the theory of MMT. The problem is it doesn't really work because it creates inflation, as we found out. But Sam Altman, who is the owner of OpenAI, had started an experiment 3 years ago. And he selected 2 states, Illinois and Texas. And he said, okay, we're going to send checks for $1,000 a month to people in Illinois and Texas for 3 years. And we're going to see how it improves their quality of life. This is going to be great. So this is going to prove this whole idea of MMT and universal basic income, right? If we just give people a universal basic income, it's going to make everybody better, right? What would you do if you had $1,000 more a month, right? That's the question, right? You would go out and obviously you would pursue education and you would pursue things to improve the quality of your life. Right, that's what you would expect people to do. Go out and get a better job, get training, whatever it is. That's what you would expect people to do if they had an extra $1,000 a month. No strings attached, by the way, for doing this. Well, 3-year study, largest ever of its kind, and found out that people just basically took more leisure time. They didn't really do much. They spent the extra $1,000, but they didn't do much to improve the quality of their life. They just actually worked less, which is kind of what you would expect. Give me extra money a month, I'm going to work a whole lot less. Trust me. But anyway, not surprising the end result of that, but I've got an article coming out on it in the next week or so. So we'll have that on the website. We'll talk about it here. But the study was quite interesting and really not surprising at all. Okay, let's talk a little bit of what you need to know before the bell this morning. So last week, we had this correction, went down, tested the 50-day moving average. On Friday, had a very decent rally, getting back above the 50-day. So again, we talked about this last week. Just a violation of the moving average on one day doesn't mean anything. A lot of people are like, oh, we broke the 50-day, got to sell. Be really careful with that, because generally markets do exactly what they do, is they get oversold during the sell-off, and we were certainly oversold here. So on Friday, we bounced, got back above that 50-day moving average. The sell signal is still firmly in place here, so it is unlikely that the current correction is over yet, but I wouldn't be surprised to see this market try to rally for a day or so. Again, we are oversold enough now to get a bit of a bounce here, see some money rotate back into large cap techs, etc. Wouldn't be surprising to see that happen. But any rally that you get pushing up towards that 20-day moving average, which is now resistance, we took out that support, that running support line, turned it into resistance now on a test. So the market rallied back to the 20-day. I would take profits there, reduce exposure, do what you need to your portfolio to kind of clean things up. If you didn't like the sell-off, hurt you, right? It means you got too much risk in your portfolio. So use this rally to kind of clean things up. We've got this gap that opened up. When we broke the 20-day, we gap lower. So we've got to also fill that gap to the upside to reverse this current sell-off process. I don't think we're going to do that on the first attempt. We may. It's possible we get, the Fed announces tomorrow, hey, we're going to cut rates for sure in September, whatever it is. This market gets all excited. We could certainly rally back above that 20-day moving average. If we do that, that's going to reverse the sell-off, and that'll pretty much mean the sell-off's over. We test previous highs, break out the new highs, the sell-off is over. But it's likely that we've got some more work to do here first. Again, the sell signal's in place. That's going to keep pressure on prices here at least for a bit. Market rallies back to a bit of an oversold condition, get another leg of this correction here before it's done. August tends to be not a great month, but it's not terrible, historically speaking. September tends to be worse. So again, we could be in this correctional process here for a month or two heading into the election. Unlike we saw in April, which was about a 1 month correction, and then we took off running again. This could be more like we saw in last kind of September, October, where the market's just kind of ground lower for a couple of months. And again, as we kind of just really, watch this, kind of last, September, October, we were just kind of grinding this portfolio, the market lower. We kept rallying back above moving averages. We thought we were kind of out of the woods, and then the market would kind of sell off a bit. We'd rally back, sell off some more. That could be, I'm not saying this is how this is going to play out. I'm just saying this is one of the potential possibilities that we could work through. We're currently kind of working through this initial part of the sell-off, but again, as we start to head into the election, markets are overvalued on a lot of fronts. We've got a lot of crowding into trades right now. Right now, it's the small cap Russell trade that's got huge options outstanding on IWM as an example. Those are typically great shorting points. So we could see another rotation within the markets. If earnings, we're starting to get fairly sharp earnings, negative earnings revisions on companies as they're missing estimates. Not surprising, I've warned you about millennial earnings season. And so we're now starting to see those downward revisions to 2025 earnings as well starting to come through. So that could put more pressure on the markets, get de-risking heading into the election. That's one option, right? So again, I'm not saying that that's going to happen for certain, but it's certainly worth just kind of keeping your back of mind. Just, be careful here. Use a rally at this point to sell into, don't try to buy the dip here. It's way too early. We're still on a big sell signal. Use the rally to reduce exposure, rebalance your portfolio, do what you need to do just to kind of minimize your risk levels, to where you're comfortable if this market does continue a correction over the next month or so. Now, once we reverse this and break out to new highs, obviously correction's over, and it's going to be kind of upside from there, but that may be a little bit of time before we get there. So that's what you need to know before the bell this morning. All right, when we come back, we'll talk a little bit about people. And another reason we could have a bigger sell-off still, we got too many people way too bullish on the markets. We'll talk about that next. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Hang on just a second. I'm trying to get something together here. So it was interesting. Over the weekend, obviously, the Olympics kicked off in France, and it was quite an interesting opening, which Paris has now come out and apologized for. Brent, did you watch the openings of the Olympics?
No. I had other things to do this weekend.
You had better things to do?
Yes.
Yeah.
That's a whole other story.
It's a whole other story. But I have a picture of it. So this, give me a second here. But this is Paris after the opening of the Olympics. And you will notice that there is like no power in Paris. And this is because, so during the opening of the Olympics, if you're not aware of this, now leave this picture up for a second because there's an important point about it.
All right.
So at the openings of the Olympics, they did a rendition of the Lord's Supper, Lord's Last Supper, right? And it was all, transvestites, transsexuals, etc., all kind of doing the Lord's Last Supper. And then they had a rider on a pale horse dressed in the silver cloak representing the pale rider of death in Revelations, basically. And so, there was a lot of outrage over this from the Christian community, not surprisingly. And shortly after that, the entire city of Paris goes into a blackout, except, don't zoom in. Do you see that building in the far back left corner that has lights? That's the church. The only building in Paris with electric power was a church. So, I don't know if the Lord had something to say about the opening of the ceremony, but there, sometimes they say the Lord works in mysterious ways. Just thought it was interesting.
Coincidence?
It could just complete coinky potentially. So I just did think it was interesting. The only space, and there's a good picture from Reuters, by the way. Anyway. So, one of the issues that I was just talking about a second ago is that this kind of correctional process that we're going through is interesting. Already, I did a segment with Adam Taggart over the weekend on Thoughtful Money, And, we were talking about this correction process, et cetera. And of course, the headline, he always has to come up with some dire, end of the world headline that, is about this, and made it sound like that I just I'm selling everything, right? I'm just selling all my stocks and going to cash. And of course, the comments are like, worst advice ever from this guy. He's recommending you sell everything. As you know, that is not the case, right? Did we take profits in some of our stocks here, week before last? Yes, right? We were worried about this correction. But the issue with this current correction is it could be mild, or as I was saying just a moment ago and before the bell segment, that this could be something closer to what we saw last September, October heading into the election. We certainly have the historical precedents set up for a deeper correction. But also, it doesn't mean it has to work out that way, right? I mean, we've already kind of started this correction. We're down about 3%, to the lows, and we had a little bit of a rally on Friday. Probably we'll get a little bit more of a bounce here. I don't think the correctional process is over yet. I think we have some more work to do. Now, it could. Now, the markets can do anything, right? So I just, nobody knows what the market's going to do 3 days from now, much less 3 months from now, right? All we can try to do is look at historical statistics, technicals, kind of things that are going on in the markets, and try to make some assumptions about where the herd is heading, right? We're kind of looking at the market as a collective, set of cows, and are they all headed in one direction or not, right? Or is there a few kind of peeling off to one side, right? We don't know that. We don't know any of that. We don't know what's going to happen 3 days from now. Good example was last week, the meteorologist kept saying there was a 90% chance of rain, like Tuesday, Wednesday, Thursday. It was going to rain all week. I got no rain Tuesday, Wednesday, Thursday. It rained cats and dogs Thursday, Friday, Saturday, right? And Sunday morning, right? Just torrential downpours at my house. But, for 3 days, I had no rain at all. So, this is the problem with forecasts. They're very, very difficult. But we have to make, as investors, we have to kind of make some assumptions about where risk is and what that potentially means, for outcomes, because that's, because we're trying to navigate and manage money. So this correction could be very shallow. We rally right back up to new highs because the Fed cuts rates on Wednesday, as an example. I'm not saying they will, but let's say they come out and surprise rate cut. This market's going to run right up to new highs, right? This correction will be over. Barring something like that, I suspect that this market could rally a little bit, correct again, and then we'll see if we put in a low. But there's one big difference right now versus in this correctional process versus, other market periods where we kind of set market lows. And, and that's the thing that we have to look at is how investors are allocated, right? Are they bullish? Are they bearish? And where this, so your best buying opportunity. So when you're looking for that opportunity to put capital to work. So let's rewind the tape to last October. Last October, we were talking about everybody at that point, everybody's very bearish on the markets. Markets are going to keep going lower. The rally's over. We're going to go back to retest the 2022 lows, yada, yada, yada. And I was saying, no, probably not the case because we have exceptionally bearish positioning in the markets, which typically tend to mark bottoms in markets, not tops in markets. And of course, we had a rally, November, January, February, March, April, May. So that's what we don't have right now. People are very, very bullish on the overall markets. And I thought this was, important because again, even though we had this correction as an example last week, volatility didn't rise that much. Yeah, it was up a bit. We hit 18, last week, and that was, a big move, right? We had a big move in volatility. But if you look at it in context, this is kind of a normal correctional pickup in volatility. This isn't something that suggests a larger correction process is in place. Investors are very, very complacent right now. They don't really feel like there's a lot of risk. But let's go back and look at the market in last October when we were writing that, hey, we're probably going to rally and have a year. I said the name of the article was More October Pain Before a Year-End Rally. That was the name of the article. And in our article, we posted a few charts. This was a chart of our net bullish sentiment last October. As you can see, bullish sentiment was extremely bearish. In fact, it was as bearish as it was, almost going back to the financial crisis. So at that point, you're going, okay, everybody's bearish, which means that everybody's on kind of one side of the boat, and that tends to give you a decent opportunity to invest capital, right? So the number of stocks on bullish buy signals, as an example, also extremely low. In fact, the lowest levels we had seen since the financial crisis. Stocks, there weren't any stocks on bullish buy signals last October. So again, these are what we call contrarian indicators to the market. So let's converse that to today, where we are as of last Friday. Bullish sentiment is near its peaks, right? So these are the same two charts that I just showed you, near bullish peaks, not October lows, right? By any stretch of the imagination. Which means investors are kind of all on one side of the market. They're all long equities. And they're very optimistic about it. Take a look at net bullish sentiment again. How many stocks are on buy signals versus sell signals? That's near its peak, not its lows. So again, these are all things that suggest that investors are still very long allocated in the markets, which in order to have a better buying opportunity, and this is kind of goes to our point that we could see a bit of a bigger correction still, is that for markets to get into a position to be a much better entry opportunity, we need to work off a lot of this excess bullish sentiment. And if you take a look at how equity allocations by both professional and retail investors, those are near peaks as well. They've come down a little bit. All these indicators have come down a smidge over the last week or two because of the sell-off, but there's no panic. Everybody's still, it's like, it's just a correction. It's going to go right back up again. That's the general attitude. And that's okay, right? And it may. We don't have to work these things off very quickly, but they do tend to reverse over time. If you take a look at, so we have an indicator that we run every week in our newsletter. It's called our Fear Greed Index. And this is based on allocation. So this is different than the CNN version of Fear Greed, which is based basically on the S&P 500. This is based on how are investors allocated. And you can see last October, those allocations were extremely low. Now they're extremely high. So again, everybody's kind of on the bullish side of the boat right now. So the point of all this conversation is simply to say that there is fuel because of if we get into, if this continuation of this correction continues into August, September, there's fuel for the unwinding of portfolios to have a 5 to 10% correction. We're not there yet, but the risk of a 5 to 10% correction sometime this summer is very present because everybody's very bullish. We haven't worked that off yet. There's no fear in the market. So if something happens in the month of August that starts to instill more fear into the overall market, just fear about the election itself and what the outcomes could be, we could see a bit more of that de-risking of portfolios, and there's fuel to drag this market lower. So the point here is just to be careful, be a little cautious, which is why we're talking about managing risk. Being a little bit more risk averse now may pay off later into the summer until we get into a better buying position. Okay, be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult.
There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the last 2 years, there's been a massive drop-off. Like, nobody's naming their kid Alexa anymore. But yeah, because you go, Alexa, stop that, and all your lights go off.
The Real Investment Show podcast.
And I'm sure the kids at school were getting teased. You know, hey, Alexa, ask a question.
Same show, your schedule.
I haven't heard of any kids being named Siri.
Not yet. I'm sure there are. I am sure there are. And there's probably some kid named Bixby somewhere.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. James. Talking to you, James. James B47A, whatever that is. I don't know what that means. But anyway, James, do you think I don't do my research, right? Especially when I'm writing an article about something. James says in our chat, using Lance's logic, we give business owners tax breaks that will make them lazy and cause them not to work as hard. By the way, no one got $1,000 every month. They only got it for 1 month. That is incorrect, sir, on both counts. Here's the article itself about the 5 researchers that published the study. 5 researchers published the paper, tracked 1,000 people in Illinois and Texas over 3 years who were given $1,000 monthly gifts from a nonprofit that funded the study. The average household income for the study's participants was $29,000 in 2019. This is 3 years later, obviously. And relative to the control group of 2,000 people who only received $50 a month, the average person worked 1.3 hours less per week. No, tax cuts are vastly different. Tax cuts benefit businesses because they don't pay as much in taxes, but it doesn't deter is the word I meant to use. It doesn't deter business owners from working harder because they get to keep more of their money. So I am more incented to work with a tax cut because I keep more of my money. I am less incented by tax hikes to work harder because you're taking more money from me. So this is the whole flaw between a 90%, people, we should just charge the rich 90% taxes or whatever, some, astronomical tax rate. By the way, the tax rate in France is going to 90%, which is why in my earlier life, I worked with high net worth citizens in France, moving their money out of France so they could keep more of it by doing real estate internationally, right? So they didn't want to have their money in France because of 90% tax rate. Didn't deter them from working, but they wanted to figure out ways to keep more of their money. So that's why high tax rates are never beneficial, because that actually does deter individuals from working harder. Why should I work harder if you're going to take 90% of my money? It makes no sense, right? I'll just be poor and get more stuff from the government. Duh, right? So, James, please do your research before you make comments. It's not that difficult. Anyway, okay. People. Where was I? Oh yeah, we were talking about markets. So anyway, we could certainly have, as I said, we were just kind of wrapping up that conversation. We certainly have a bit more of a correction here, so don't be surprised. This could be a shallow correction, runs off to new highs, could be bigger. Just we'll navigate it as we go, and that's why we're here every day to basically talk about it. So outside of that, earnings, as I talked a little bit about earlier, earnings are beginning to come in, and already we're seeing quite a few negative revisions to both 2024 earnings as well as 2025 earnings. Remember those really lofty earnings estimates I showed you previously? Yeah, those are coming down pretty quickly. And, not surprising, first of all, as high interest rates are weighing on consumption. Where do earnings come from? They just don't come out of the blue, right? They're just not magically created. It's like, oh, we have this much in earnings. They have to come from revenue. And as consumers come under more pressure, they have less ability to generate economic activity, which is where earnings come from. So not surprising, as we're seeing the economy slow down on a lot of different fronts, a lot of the latest economic data, and both inflation as well. Inflation falling is not good for earnings. So not surprising we're seeing these negative revisions to earnings. Now, the problem right now, as we talked about previously, is this whole shift to small cap, which this is a very big issue over the last couple of weeks. This big rotation to small cap is a big function of the yen carry trade. That is a huge source of leverage for hedge funds, which, as I noted last week, hedge funds are not hedged very much. They don't have a lot of short positions. So basically, if you're in a hedge fund, you've got a very high cost S&P index at this point because they're mostly just long stocks. The hedge fund trade was to be long mega cap stocks and short small caps because there's no earnings growth. I've got a chart here of earnings growth of the mega caps versus small caps. Or sorry, let me rephrase that. I have a chart here of earnings for the S&P 500, large caps versus small and mid caps, the Russell 2000. Earnings are growing for large caps. They're not growing for small caps. So because of that differential in earnings growth, the trade was to be long large caps, short small caps, and do it on leverage, a lot of leverage, by using the yen carry trade. And Michael Leibowitz has an article coming out. If you want to know what the yen carry trade is in great detail, Michael Leibowitz will have an article on Wednesday on the yen carry trade. We'll talk about it on Thursday. But suffice it to say is that the yen carry trade allows for a lot of leverage in hedge funds. And because they can short the yen, go long U.S. treasuries, and then leverage the treasuries to buy stocks. So when the yen reversed, margin calls came. I have to cover my yen shorts. I have to cover that. And so as I cover those shorts, I've also got to rebalance my allocations, which means I had to sell large caps and cover my Russell 2000 small cap shorts. And that caused this big, massive surge. Now, the risk going forward is the theme over the last couple of days, like, here's the big rotation. Sell large caps, buy small mid caps. The problem is they don't have any earnings growth, which is what drives asset prices over time. So, this trade can certainly last a while longer. If the yen keeps coming down, you're going to have more forced unwinding of more of these hedge funds, right? They're going to have to rebalance their positioning, which could certainly lead to a further rally in small caps. But to make a long-term bet on small and mid-cap stocks, the risk is the earnings growth. And with earnings growth now slowing down at the top line in the large caps as well, that puts even more pressure on earnings growth on small and mid caps as well. So just the point here is that if, we have a couple of small mid cap stocks in our portfolio, so we're watching those closely. They've done well lately. But we're very cautious with them because of these earnings issues. So just something to focus on. If you've got a lot of bet, if you're making a big bet on small and mid cap stocks, having this big, massive recovery, be a little cautious with that. I'm not saying it can't happen. Anything can happen. Remember, anything can happen in the market. The market is going to do anything they want to do. But on a fundamental basis, there's some challenges there. So just something to at least be somewhat, cognizant of as we go forward. And the second thing is that if the economy is indeed slowing down, there's a very high correlation between small and mid caps and the NFIB Consumer Confidence Index, because that is small businesses. And right now there's a fairly big gap between small and mid cap stocks and the NFIB Confidence Index. And this is a year-over-year rate of change in both. Not surprisingly, there's a fairly high correlation, because if small business owners aren't confident, it's because the economy is slowing down. They're having trouble generating earnings, and that's going to reflect in revenues. That's why there's a high correlation between these two indexes. And that current gap is going to get filled. Either the economy is going to pick up strength, which it can, and confidence will improve sharply to catch up with what's going on in small caps. So the question is this: are small caps leading the way? Are small caps right now, this big surge in small caps, is it just a reflection of the unwinding of the hedge fund carry trade, or is it telling us that there is a resurgence in economic activity coming? I don't see that part yet, but it doesn't mean it's not happening, right? There could be this whole underground, grassroots growth in the economy. All of a sudden, we're starting to just manufacture a whole bunch of new stuff, right? I don't see evidence of that yet, but it doesn't mean it's not happening, right? Because all the data we're working with is very lagged. And maybe something happened over the last month or so that's sparked some type of economic growth spurt in the economy. Could be. My gut tells me that that's not the case. And if that's the case, then the Russell 2000 will have to catch down to economic sentiment, which I think is probably more realistic. Again, could be anything, but it's at least worth paying attention to, kind of over the next few weeks. One of the other big problems, and we've talked about this before, is that with small and mid caps, they're very susceptible to bankruptcies. They're also very susceptible to auto delinquencies, credit card delinquencies, these type of things. So most of your small cap, mid cap companies are, and businesses, right? Most of your small businesses, they rely on credit card payments for their money. They rely on, how many auto dealers do you know, right? Used car dealers, new car dealers that are owned by a regional family, right, or whatever. But it's a small business. It's a big business, but it's a small business in relative terms. But we're seeing delinquencies rise on credit cards as well as auto loans, and this is the transition into serious delinquency of credit cards by 90 days or more by age. And we're seeing a sharp rise in that. So in other words, like for instance, seeing what we see with McDonald's today in terms of their earnings announcements, not surprising, because we're seeing this kind of pressure on consumers. And again, that's going to reflect back onto ultimately small and medium-sized businesses, which are 50% of the economy, by the way, which makes it more difficult for that earnings growth to occur to support a continued bull market in small and mid-cap stocks relative to large caps, which actually have the ability to grow earnings. So we'll just be careful here. But again, we're just kind of watching this unfold, and there's some reason things are happening, and a lot of this has to do with the drop in the yen and whether or not that continues. So again, we'll talk about that more on Thursday with Michael Leibowitz. Stick around. We'll come back, finish up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show. Getting ready to kind of wrap things up. Look, I'm going to start chastising you people in the chat if y'all don't stop. I don't mind having conversations with y'all if y'all are being realistic, but when y'all get kind of over into the insane side of the equation, we're gonna have to have a talk, right? Don't forget also the power to ban you. Which actually Brent does. I don't, but Brent does. So behave. All right. A couple of things. This morning, futures are, pointing up. Dow's up about 167 points right now. S&P, NASDAQ up. Again, not surprising. We had this, fairly decent sell-off last week. Market rallied a bit on Friday, rallying a bit today, and I wouldn't be surprised to see markets kind of rally over the next day or two heading into the Fed meeting on Wednesday. Expectations are the Fed is not going to cut rates, but they could. Right? There is a small chance. Fed fund futures have been pricing in a small chance of a July rate cut, which would surprise markets to a degree. I think if you got a rate cut here, and that could push stocks markedly higher in the very short term on expectations of monetary accommodation. It could also work in reverse, which is, are you seeing something in the economy that you're not telling us, right? And could spook markets into selling off, if that's the way they take it. But right now the implied open on the S&P is up about another 23 points this morning, so it's up about 0.5% higher this morning at the open. So again, not surprising. Again, we're oversold enough, as I said earlier, for a bit of a rally here. But I would, again, as I said earlier, use this rally to kind of rebalance risk, etc. So kind of looking out over the next couple of months, economic data is going to become very key. Now, we've got the Fed meeting on Wednesday, but they will have the employment report, which is out on Friday. So they will know what is going on with employment. Now, employment's been doing okay, right? So jobless claims remain low. Unemployment rate is around 4.1%. It's rising, right? But it's not off to the races yet. So employment's kind of hanging in there if you don't look below the surface, right? If we look below the surface, Temp hires are declining rather sharply. First sign of an economic slowdown. Businesses stop hiring temp workers. You're seeing, part-time work that is outpacing full-time labor. Full-time employment's declining. It's now negative on a year-over-year basis. So there's certainly indications that employment is slowing down across the board as the economy contracts. So we had this big economic boom because of all the stimulus and everything else we put into the markets, but that's now all fading, as was expected, right? And there's not a lot of other stimulus coming in at this point to help support that economic activity. So, one of the big challenges going into the election is if the economy really starts to deteriorate over the next couple of months. That's going to be more problematic for the incumbent in particular if that happens. Because again, that's already part of the economic, issues right now. When somebody's asked about, well, how do you feel about the current administration? Well, the economy sucks. That's kind of the view, and approval ratings on economic growth are weak. And, people are under pressure. They don't have money to spend. Inflation's been a problem. So the attitude about the economy is already weak. And so if the economy deteriorates further, that's going to become even more problematic heading into the election in November. So again, this is worth paying attention to because there's ramifications to the markets as well as to the outcome of the election based on what happens between now and October in particular. So we'll see. We'll see what happens. Outside of that, big earnings week. Got a lot of earnings out this week. Obviously, McDonald's today, because we already talked about it. But Microsoft is this week. Advanced Micro Devices, Electronic Arts, JetBlue, First Solar. Merck is out this week as well. Pfizer, Procter & Gamble, Starbucks, SoFi. That's all on Tuesday. On Wednesday is Meta, Altria, ARM, which is the other semiconductor company, Boeing, Carvana, Generac, Humana, Kraft Heinz Company, MasterCard, Norwegian Cruise Lines, Paycom, Qualcomm. And that's the short list. I mean, there are literally hundreds of companies reporting this week. Thursday, Apple, Amazon. So all the big mega caps are reporting earnings this week. For the most part, except NVIDIA. NVIDIA is going to be very late. They are going to report in August. So they're very late to report. But this week, Chevron, ExxonMobil on Friday, you've got a lot of big companies reporting. So this is going to be moving the markets this week in particular. And of course, we'll be talking a lot about the earnings as they occur over the next week or so. But again, there's going to be a lot of earnings hitting the market. So, this whole concern about AI and all that, is it real? Is it justified? Or are these companies going to come in and just crush earnings? Google reported earnings that were good, but they did miss on the YouTube side a little bit. Sorry. They did miss on the YouTube side just a little bit, but the earnings overall were good. But they didn't crush earnings. And see, that's part of the problem that the market has right now, is that expectations have gotten so high for these companies that the goals are almost unattainable. And they come in, they beat earnings, and then it's like, well, you didn't crush earnings, right? We don't want just a beat. We want an absolute massacre of these earnings estimates. And that's probably not going to happen. So there could be, one of the risks to this week is with Microsoft, Amazon, Apple, these companies, they come in, they beat earnings, but they don't crush it. And so the stocks will be down. But if they miss earnings, there's a risk. And again, this is not a minimal risk. There's a decent sized risk of these stocks being down 5 or 10% at the open. Which would obviously, because they make up 35% of the S&P 500, there's a real risk this week those stocks could be dragging on the overall S&P 500. Well, and again, it's all going to depend on what those earnings look like. And this is one of the reasons that we took profits in all of these companies week before last, because I don't know what they're going to be. Nobody does. We've cut estimates for these companies going into this, so there's a fairly high probability that these companies will beat earnings estimates, by some small fraction. But again, what do they say about the future? That's going to be important. And do they crush earnings, right? This is what Wall Street's looking for. So again, there's real risk that these stocks could be down a bit this week. We'll obviously analyze the earnings with you and talk about, kind of how they report and what it looks like, and what that potentially means. But again, there's a good bit of risk to those earnings this week that we'll be paying very close attention to. Also, like I said, on Friday, non-farm payrolls, average hourly earnings. There's a good bit of economic data out this week. They'll give us kind of a good view into what the economy is going to look like over the course of the next couple of months. Are we slowing down, continuing to slow down? Are we starting to see it stabilize? Those are going to be the big questions we'll go through. But as we get the economic data in, we'll go into that with you. All right, getting ready to wrap up the show. Last couple of things here. NVIDIA to drop down to $70 per share. Maybe. I don't know, Larry, where you're picking that number out of, but maybe. We'll see. Gen, so I'm just going through your chat now. Gen AI companies to sell to each other. Yeah, probably, because there's not that many of those companies out right now. So we'll see what happens. There's one of the issues to be paying attention to, again, is earnings revisions. Pay attention to that. And I'm going to update our millennial earnings chart once we get through earnings. We'll review kind of what it looks like. We did an article on this going into earnings, kind of laying out how much they'd already cut earnings for the second quarter. We'll look at just how well they did on those estimates at the end of the second quarter. But again, this is the game. Right? We cut earnings, and then we beat them. But interestingly enough, expectations for earnings growth going into the end of this year and into next year in particular are extraordinarily high. So one thing we'll be kind of looking at is how much those as we get through this quarter, we'll see how far they bring down those 2025 estimates. I suspect it'll be quite substantially, probably to the tune around $10 per share, somewhere around there. But I'll bring you that data once we get there. But again, we're too early into earnings season right now. By the time we get through this week and next week, we'll have basically all of the S&P 500 will reported, give or take about 80% of it. So we're going to have a really, really good handle by the end of next week on what earnings for the S&P 500 really kind of actually look like. And then valuations, those are the other issues. All right. Now, tomorrow, of course, John Penn will be joining me. We'll talk about some client issues tomorrow. We've been getting a lot of client emails as of late and prospect emails as of late asking really important questions about the markets, money management, financial planning, etc. So I'll go over those with John Penn tomorrow. In the meantime, have a great day. Settle down in the chat or else. And I will see you back here tomorrow. Be sure to go by the website. Our latest newsletter is out. Daily market commentary on the website now. All there, realinvestmentadvice.com. And importantly, read stuff, right? It's important. Read it. And then comment. It's all good. All right. Have a great day. We'll see you back here tomorrow.